Good afternoon, everybody, or morning if you're on the East Coast or West Coast. Welcome into the Wolf Financial Live today. My name is Gav. I'm the CEO at Wolf Financial here today with Uktai. Welcome to the live stream. So excited to talk about income investing, leverage investing, and a few other things together with you.
Awesome. Thank you for having me, Gav. Looking forward to it.
Yeah, my pleasure. So let's start out actually with kind of these topics of leverage and income. These are the hot trends of 2025, and we're seeing them come into 2026. There have been studies done by JP Morgan, BlackRock, others that say, they're going to see tens of billions of dollars of AUM coming into these areas. Nobody knows them better than you, to be honest. This is your bread and butter. Why is leverage investing, and we're seeing a lot of single stock leverage investing and then income investing, why are these making up so much of retail investors' interest these days, drawing such big communities and crowds? And then I'll have a couple questions off of that.
Sure. I mean, if I would, summarize it into one word, I would just say convenience. Convenience is one of the things that people value today more than I think any time before. And what the ETF or ETP structure in Europe, which is very popular, what it offers is convenience and ease. So when you buy these products, you have the same experience with them as you've had with any other stock, as with any other ETF. So it's a structure that you're familiar trading, getting in and out of. So, here in Europe, we have different structures like CFDs. These are what Europeans have predominantly been trading over the years. And obviously, stateside, getting leverage has been, mainly through options. It's been through, trading on margin. But they all come with their own share of basically complexities. So with ETFs, you buy, you sell just like any other stock, and you get that daily levered exposure. So that's, I think, one of the main reasons why it's been taking off like absolutely crazy. Back in 2018, that's when we launched our first what are called single stock ETPs here in Europe. So that was a concept that hadn't been done anywhere globally, right? So people knew about, let's say, triple levered NASDAQ or triple levered commodities, even fixed income, but nobody had applied that leverage exposure to single stocks. So that's how Leverage Shares was born about 8 years ago now. And we now have products that go up to even much higher leverage here in Europe than what investors in the US might be accustomed to. But when it comes to leverage, when it comes to income investing, which I think we'll discuss separately, I think at the end of the day, it's all about investors valuing their time. They want that ease and they want that convenience and familiarity that they're accustomed to.
Yeah, I like that as an explanation, right? People are familiar with the buying and selling of a stock or an ETF. They always have kind of looked at what they saw were more advanced strategies for other investors, right? To say, oh, I don't want to take on leverage, right? I don't want to take that risk. Or for income, right? I hear people saying they make so much money selling covered calls, but I don't want to go down that path, right? Maybe they have one bad experience and then it just becomes tougher. So talking about leverage here for a second, you did mention, triple leveraged, right? There's even more than that. And you do have a great suite of products that are very attractive to those that are able to access them over in Europe. Can you talk about how European investors versus US investors think about leverage, the regulation, like, because you're kind of in the center of all of that. And do you think Americans are wanting those higher leverage products and wanting to be able to utilize them?
So I think especially for those viewers that might be based in the US, I think what you have to understand about the European landscape is that there's a lot of structural differences that most American investors don't even have to think about. You have different languages, you have different currencies, obviously there's different tax treatments. But what that means is that as an issuer or as a company that makes these investment products like ourselves, you can't have a one size fits all approach for all of the markets. So one of the things that you have to battle with is this fragmentation that you have in the different markets. But thankfully, we've had the likes of, let's say, the European equivalent of names like Robinhood, which here would be something like a Trading 212. Maybe some other names that UK and European investors would be familiar with. But once they sort of brought down the barriers to investing for a lot of retail investors to be able to make an account with just a few euros or a few pounds, to be able to get access to their favorite stocks and overseas stocks and ETFs. It just changed the landscape completely. And I think it was a really slow burn, probably up until 2020. But what we've seen ever since, I would say the beginning of COVID, is this upward ascent that really hasn't slowed down, and I would say has even accelerated over the last few years. So we came to market and made a name for ourselves with the leveraged offerings. So it was a niche that we thought we could exploit, and I think we did that. We currently have the most traded product on the London Stock Exchange, which is triple levered Tesla. But as we saw this entire category of income investing being born, and I saw all these sort of Reddit groups and all these people across social media talking about income investing and retiring off their investments, I realized that there were no offerings in Europe that offered that similar type of exposure. And what I mean by that is not only you're getting exposure to some of your favorite investments, but you're also collecting a monthly paycheck from it in the form of distributions.
Mm.
So a few years after launching leverage shares, we thought going down the income option space was the next logical step for us. In about a year and a half, we launched our sub brand called Income Shares, and yeah, I mean, I think once again, it was very slow at the beginning to sort of educate the market on how it works and what
Right.
the investment merits are, but over time, we see that that it's been growing quite at a fast pace.
That's a pretty awesome claim to fame. The most traded product on the London Stock Exchange. Casual drop there. I do want to talk more about, the specifics of the company and the product. So real quick,
Mhm.
as we're going through this, compliance voice over here for those that are watching. Those that are watching probably know that we love working together with themes and leverage shares. Investors, please, for any of the funds that we're talking about, carefully consider the fund's investment objectives, risk, charges, and expenses prior to investing. The fund's prospectus and the summary prospectus contain this and all the other information about leverage shares and themes, which you could check out directly on their website, right? You can obtain the fund's prospectus and summary prospectus right on their website, and it contains all the information that you should read prior to investing. So just want to put that out there for people, and maybe actually just ask you for a second. I'm sure you encourage people as well to read this information. Where do you think is the what do you think is the best way? Because for something that's like a leveraged product, right? Necessarily, there's not like it's not like going and finding a new stock and doing your research on it, right? Typically, you're taking a pre-existing stock that you have knowledge of and trading it. How do you think people should do their research and properly risk manage?
I think if this is the first time or one of the first few times that you're even hearing about these products, the very best thing that you can do is sort of find any free type of education that you can find online and any type of free resource to try to understand what the structure of these products is and how they work. So don't necessarily rely on the issuer to get you the best, form of education that you might need on these products. Like one of the things that we saw over the years is a massive misconception in how these products work, right? Especially this concept of daily leverage. It confuses so many people because they buy, they hold for a month, and the underlying performance doesn't match what happened on the double or triple levered equivalent of that product. So, the best place to find more information about the products from our perspective is always our website to find more information about our products. So in Europe, we have these regulatory required documents like fact sheets and key information documents where all of the key risks are highlighted. But even beyond that, because in many cases that won't be enough of a resource for investors to educate themselves. So go on YouTube, if you have to, go to the library, go on all these free resources that you have online, but make sure you really understand how these products work. Because if it's a wide spectrum where you have these plain vanilla S&P 500 ETFs on the one end, the leverage and the options income is very much on the opposite end of these of that spectrum. So really have a good idea of what you're trading before you even put a single dollar in these products.
Yeah, maybe going a little bit deeper into the idea of daily leverage. Is there an optimal holding time period that you think of when it comes to these leverage products? Because there's, been a lot of discussion with people. Hey, if you have a triple leverage product, it's tough to hold that for years if it goes a certain way. But I'm just curious how you think about it over time.
So over time, if you can tell me what's going to happen 1 month down the line, 2 months down the line, I will tell you exactly how long to hold it. But the thing with these leveraged ETFs, so the fact that they're exchange traded means that leverage has to be reset on a daily basis. So the reasoning behind that is if someone were to buy today, tomorrow, or 1 week down the line, and if each of those people held for a single day, they would have the exact same experience because they're buying something that's traded on exchange. So that's why when you have this daily reset over longer holding periods, what happens is this compounding. So if the market keeps going in your favor, meaning you have a green day followed by a green day followed by another green day, then all of a sudden the cumulative performance might even be higher than the expected 3x. But if you have this choppy period, then there's really no link between what the leveraged ETF will do and what the underlying would do. It might be the same, it might underperform, but there's literally no way to know just because you have to know the exact path of what the underlying will do to see how that will play out on the leverage version of that underlying.
Got it. Makes sense. And I think that's important for people to understand there, right? Because I'm sure you get a lot of people that say, hey, well, look at the past year of this versus that, right? And the two aren't lining up. And this is something that I think is important. I personally like to use these products for more of a trading oriented approach, right? If I think that there's going to be news, earnings, something along those lines, but I don't want to go in and take options because in case I am wrong, right? And the theta just gets destroyed or something along those lines, I can take less risk here and utilize some of these other products and go about it. And I saw a lot of people doing that with some of the US products throughout this year. And I know we're not talking to those specifically here. And I'm sure people do it over in Europe with their products as well, where they're going about saying, hey, there's a catalyst here. And that's why when you say triple leverage Tesla is the most traded on the London Stock Exchange, well,
Yeah.
most traded makes sense right there, right? Because it's changing hands all the time. People are using it to trade. They're looking at what is Elon Musk doing, right? He's speaking at WEF today. Is this going to cause something here? Can I trade around some of these different pieces? So I think that makes a lot of sense to me.
Yeah, exactly. I mean, this is very much for the active trader, right? So either you're getting in and out intraday or you're planning on holding for a day or probably at most just a few days, right? So just to give you an example, I mean, I pulled up a chart just before getting on the call. I was looking at Tesla for the last 1 year. The stock itself is up right around 4%. And I don't want to talk about specific tickers, so I'll just say like a 2x version of Tesla was down 35%.
Wow.
A 3x leverage version of Tesla was down 73%. And then if you thought the inverse versions of Tesla would have outperformed over that entire period, the 3x short version of Tesla was down 90%. So that's why I say once you hold beyond just a few days, you lose that, any kind of link between what the underlying does and what the inverse or leveraged version of that product does because of that daily reset.
Wow, that's so crazy, actually, what you're saying. I see that now. That, oh my gosh, Tesla, yeah, up like a few percent in that past 52 weeks, but all these products are just getting destroyed. Okay, there you go. That's I think you've set the case for people really, really well there with how they should be looking at this and comparing this. And I'll show people actually on screen actually, I think people get the general gist of some of these items. But I did want to rotate for a second to something else, which has been a really hot topic lately and something that you do have products around in Europe, which is precious metals and gold. And those have been, so top of mind. So I think we set new all-time highs for gold yesterday or the day before. Again, and we're seeing the rest of the metals run as well, silver, platinum, copper, etc. And I think that there's multiple reasons for this, whether it's because of death of the dollar, right? And people saying, hey, other countries are starting to load up on certain metals, or it's just a decade-long breakout, right? It's been consolidating for those time period. I'm really curious to hear how you look at precious metals and then the tools and the investing vehicles that you've built around them for people, how they should think about those.
So I think we're very much looking at the debasement / geopolitical instability trade playing out just at different, I would say, periods in time. Because if we're to think about sort of the more geopolitical stability that we had over the last few years, that was, I think, the first sort of driver, the catalyst for precious metals to get that first few legs up. But then, obviously with all of the narratives going around with all of the big banks hoarding gold and obviously the dollar losing a big portion of its value last year, and people were just looking for alternatives to keep up that purchasing power, because I think a lot of people still have this misconception that the US dollar is meant to be a store of value. And just like with any other fiat currency, it's just about making transactions easier. Right. So, once people really start to realize that, they start looking into alternatives. Some people might say digital gold is the answer, but if you look at the performance over the last year, Bitcoin, Ethereum, or any of the larger market cap cryptocurrencies don't necessarily fit that role, at least in the near term. And then when you look at precious metals, we've seen the massive hoarding from central banks. We've seen the massive buying from institutions, and then we've seen retail piling into it as well. And now that it's on the verge of hitting about $5,000 almost, we honestly we have over 180 products across commodities, indices, individual stocks, fixed income. And we have a few products around gold and gold miners on the leverage side. And on the income side, we have, a few precious metals products themselves. On the leverage side, for the entire year, I think the best performing product was like 3x gold miners. And this was a product that has been relatively muted, like nobody's shown any real interest in it. And all of a sudden, people started trading it a little bit more. But unfortunately, a lot of that trading sort of came after gold had appreciated quite a bit. So what I think, that's really being played out, especially over the last few months, is really people paying more and more attention to that debasement narrative. But yeah, obviously behind the reasoning for many of the bigger investors, there's a lot more onto it. But I would think that this is sort of the lion's share of people's reasoning behind investing.
Yeah, I'm glad you mentioned the gold miners as well as being one of those products that did really well. I've had a lot of discussions with my friends in the gold space about how the miners and how the exploration firms are a bit of a catch-up trade right now, right? If you look at where they're evaluating them, gold has gone all the way to it's at 48.80 today, but a lot of the miners, they still value the gold that they have at like 3,000, 3,500, and so
Yeah.
there's this arbitrage play that's happening there. And so I think a lot of people are now looking at leverage versions of those as well, right? And saying, hey, well, if I'm going to play a catch up trade, let me play a double catch up trade. And you've seen these things go absolutely spectacular in the past year.
I mean, if you look at just the price performance of gold miners versus gold, like obviously there's a correlation there, but gold miners themselves have always been almost like a leveraged version of gold. So
Yeah.
usually when gold pops, gold miner individual stocks tend to pop a little bit more, and vice versa. On the way down, you're taking the brunt of it. But yeah, that makes a lot of sense what you said.
Got it. And your product there is GLDI over in Europe that people should check out on the gold side, right?
So on the income investing side, GLDI is currently our most popular product, and it's been and like from the flow side of things, it's been the most popular just in terms of regular inflows month after month. It's very rare, especially for a company like us, where we're accustomed to seeing a lot of active traders get involved with our products. So you see a lot of inflows and you see a lot of outflows. So
Right.
that's what we've grown accustomed to seeing. But with these income shares products, what we've seen is constant inflows. So since we launched the range, we haven't had a single redemption, meaning a single
No
net
way.
outflow.
That's
Yeah,
crazy.
yeah, I'd never seen it, honestly. I've never experienced it, but it's really promising to see, especially given that at the beginning it was a really slow burn. But GLDI, that's been the most popular one.
Do you think it's because if, people don't expect gold to crash back down, but maybe to take a little bit of a breather, traverse for a little while as gold did for many years. And now they can say, hey, well, I'll still get some of that upside, but if it just traverses, I'll still be able to pull in some income.
I saw a recent Bank of America survey where it showed like the professional money managers sort of allocation to gold on a larger scale in the U.S. And I think it was something like under 2% when you take into account all of the professional money managers. And it seemed like a really low number. And what happens with gold is that you have these periods of 2, 3, 4 years where it just does absolutely nothing. And then
Right.
you have some kind of turmoil in the market and it absolutely rips. So what we thought from an income standpoint is that this is a match made in heaven. You have sort of a core holding that a lot of people think should be in every person's portfolio, that even if it does nothing, let's say over the course of a year or even longer periods, you have an options overlay on top of that. So every time you're selling calls on that product, you're able to collect premiums. So even if gold itself stays flat, those premiums that you're collecting are going to pay you that monthly income. So on a total return basis, you're even going to have some scenarios where it might outperform the underlying precious metal itself.
What do you think about others like silver, platinum, pieces like that?
I think it's more of the same story. I think the obviously for silver it's a little bit different because it is a precious metal, but it does have some obviously real world utility. But we have a silver product with an options overlay on top as well. So that's been it's one of our newer products, so it's hard to gauge how popular it'll be. But compared to the latest batch of products, it's certainly been among the most popular. So the way I think investors are playing it right now is they're trying to, once they saw the move with gold and now they're seeing what's happening with silver as well, they really want to make sure they have that next leg covered. So whether it's going to be copper or whether it's going to be some other kind of commodity, they really want to build out that commodity portion of their portfolio. So when everyone's invested in the same kind of high tech stocks or high growth stocks, high beta names, tech stocks, and the consumer discretionaries. That's where a lot of retail is currently crowded. But on the flip side, you have people that also want exposure to the growth names, but they don't want to ride that wild roller coaster throughout the same time. So what these options income products do is they sort of smoothen out the ride. So you might not capture the full upside, but in many cases, when the stock starts moving downward, you're not capturing the full downside as well. There is no downside protection, but there is still a small cushion from those option premiums that you're getting. But yeah, I mean, for the single stocks, we have a slightly different strategy, and it's really interesting to see because on certain names, we've actually outperformed the underlying. Like Tesla is one of them.
Yeah, yeah, it's pretty fascinating when you do see those outperforms. I've seen that rare instances, but right, but it's always a very cool and it does manage to happen. One other piece as well. So gold, silver doing very well this year. An area that's kind of lagging this year, besides for Google, is the Mag Seven.
Yeah.
And you have a product around Mag 7 as well that people can go check out on the European side, so MAGO. Can you talk a little about that? Obviously, they've had a great few years.
Indeed, indeed. So whatever happens, obviously Mag 7 is always front and center in terms of at least getting mentioned, even if they hadn't done much or performed poorly. So Mag 7, it's sort of an acronym that everybody knows by now. It's the biggest, or at least the most well-known tech stocks in the US markets. So we have a basket ETP around the Mag 7 stocks. So it's just a basket product where it buys each of our individual ETPs that are with options overlays on those underlying stocks. So instead of having to buy each one of them separately, we do it for you in a single product, and it's rebalanced regularly, meaning that you can get that exposure and not have to do that rebalancing or trading options directly. And for a lot of people that are sort of accustomed to traditional covered call options trading and maybe not some other strategies, we actually run an active strategy, meaning that if you wanted to sort of do the same with whether it's cash secured puts or even zero DTs in some cases, it's going to be quite hard as an individual investor to replicate it with the same level of effectiveness. So that's why, like I said at the very beginning, I think these products are popular because of not only what they offer, but because of the headache that they save for individual investors. And yeah, we have now 19 products across the range. 2025 was a breakout year for us. I think the AUM sort of grew over 10x. And I honestly think 2026 is going to be a lot more successful just because we're doubling down on all the resources that we're going to use to sort of educate the landscape on the merit of these products. And obviously, we have a massive pipeline lined up as well. So,
Yeah, you guys have brought a lot of names that people really want to market. I'll talk about that in a second. Just quick question. From my understanding, looking at the data, most of the interest for leveraged income products is coming from retail investors. Do you think that we're going to see uh, additional interest coming from financial advisors or retail investors telling financial advisors, "Hey, this is something that I want in my portfolio"?
if you're talking about leveraged and inverse, I think it's always going to be a bigger weight towards I don't want to say retail investors, because in some ways retail might be a little bit more sophisticated than even ones that are working at professional firms. But I would say it's always going to be predominantly DIY investors, just because the bigger firms and the bigger money managers, they usually have a lot more in their toolkit that's at their
Mm,
disposal. So they're already accustomed to trading futures and options and managing their
got it.
positions and hedging at will, etc. So obviously there is a pretty big proportion of more professional investors getting involved in leverage and inverse, but because of that daily reset for many of them, if they have a longer term strategy, it's sometimes harder to replicate the same with a daily leverage product, just because you have to rebalance it more frequently to get that effective leverage that you're looking for within the context of the overall portfolio.
Understood. Understood. That makes sense. Yeah, right. This is exactly the way for retail investors to be able to do these things without having to have the people that have that type of expertise. So it makes sense that the people that have that expertise would just go and execute right on those different pieces. Although I do think that for some financial advisors, they don't want to be sitting there selling covered
Indeed.
calls and stuff like that. So I could see prior leverage maybe a step further, but the income products I could definitely see, especially if they're structured correctly. How do you think about, this is obviously people probably hate it if I didn't ask, the NAV erosion, right? The
Of
pieces like
course.
that. How do you think through all those things and talk to retail investors and kind of give them confidence in the long term hold in these products?
Sure. And maybe just to put it in context, like where we are in the European landscape compared to the US within the income product sort of context. So overall ETF AUM globally, I think it's about 13 trillion in the US and it's about 3 trillion in Europe.
Okay.
So 4x bigger in the US. If you talk about the options-based income ETF space, currently JEPI alone, the big flagship product from JP Morgan, has 42 billion in AUM.
Wow.
The entire options income ETF space in Europe right now has 6 billion in AUM. So JP alone is about 6, 7 times bigger than the entire options income space in Europe. So there's a lot of room for growth. So the thing what you see with when a space is more in the nascent sort of phase of its growth is that it's probably going to grow at a faster pace. But in order to do that, people are going to start to look around. They're going to pay attention to things that other issuers before you did, what worked for them, what didn't work for them, and whether investors got burned. So one of the things that you see actively across, whether it's social media, obviously, especially on X and elsewhere, is this topic of NAV erosion. NAV erosion is one of the main things that we've been contacted about from both advisors, individual investors, etc. And it's something that everybody's concerned with because at the beginning, I think sort of the same kind of the same kind of narrative played out in the US where people were really attracted by these very high yields, but they didn't understand that those don't always translate into good total returns. So now as people pay more and more attention to them, they're actually, they're becoming even more skeptical when they're seeing a higher yield just because they're becoming more suspicious that the NAV isn't going to be able to keep in line with that. But what I can say is that if you're running a pure covered call strategy or, in our case, a pure cash secured put strategy, and you're not buying additional downside, it's always going to be a function of what the underlying is doing. So what I can say about a single stock, let's say, I don't know, Coinbase or Strategy. If Coinbase and MicroStrategy keep going up on a regular basis, you will still get that fat paycheck and your NAV will not be eroding. But all of a sudden, if those start going downward, then your NAV is going to suffer. And then those payouts all of a sudden are starting to get lower and lower because you're just getting a percent of a lower base. So those are things that are, once again, to an extent, are always dependent on the strategy itself
Right.
and the underlying. But if it's something that's a little bit more actively managed and you have, something that's tracking an index or maybe like a basket, then that's where you really have to pay attention to the portfolio manager's strategy to see how they're trying to get around that NAV erosion. So I alluded to the Tesla product a little bit earlier, right? So we talked about Tesla, how the triple levered version of it, underperformed, the inverse version underperformed. But one product that outperformed quite a bit was our Tesla options income product. So that was up 10x more than Tesla stock itself.
Wow.
Just because that was an environment where, because we're writing weekly options every single week, we were able to roll those positions and collect new premiums. And as that sort of flow compounded over time, then what you saw on a total return basis is the underlying individual stock doing better than the actual stock itself. It's rare, but it does happen.
Yeah, super, super interesting. And who's doing the management of the buying and rolling and selling positions on the back end?
So like I mentioned, we have over 180 products, right? So over the years, we have a pretty big team of traders of, I would say at this point, it's closer to 10, maybe at this point, even 15 traders. But the thing is, there aren't, individual trades, people sitting around and clicking buttons all day. It's just not manageable when you have so many different products. So obviously we have now this infrastructure that's been built. We have our systems in place. And because it's rules-based for a lot of the income products, then we know exactly where they have to be executed based on what's going on with the options market, what's going on with the underlying. And we have, slightly different option strategies as well. So obviously you really have to pay attention that nothing goes awry. But yeah, I think we've built a pretty strong infrastructure and trading system over the years that now we're basically able to handle, even if we scale the product range to over 300 products.
300's wild. How do you decide what you actually want to launch to the market?
Once again, it's somewhere between an art and a science. So it's like in many cases, you have to kind of see where the where the momentum is going. Sometimes you get it right, sometimes you don't, and then sometimes there's hype and people ask for a certain product, and sometimes that hype sort of dies off, and you launch the product and there's no interest left in it. What we're best at doing is, I think, listening to the market, because we don't have the time, the nerves, or the resources to push out new products and try to convince people to buy them. So what we do more of is pay attention to what people are telling us and try to put products into market that people are looking for. That's what we've done with basically everything that we've done within the different sub brands, and it's going to be the same thing moving forward. So as of late, people have been asking not for more individual stock income products, but mostly baskets. So I think a lot of this year is going to be putting out more basket products.
Okay. Yeah, definitely interesting. A lot of those single stocks, I guess, a lot of the favorites already got covered, right? So now you got to expand out a little bit into the baskets.
Exactly, exactly. So once you've covered the Mag 7 and then the other high beta names, all of a sudden I think the interest sort of, tends to die off quite quickly. And then you always have new entrants that come into the space. So one name that comes to mind is BMNR, has been super topical. Circle was very topical at some point. So, those might be in our plans as well. But I think with individual stocks, it's always hit and miss, especially as you go down in terms of size of the individual company itself. So it's going to be a busy year, but I think a lot of our efforts are going to be more towards the more diversified space rather than the concentrated names.
A lot of people run these like core satellite portfolios where you
Yeah.
basically have, broad-based index funds and then high beta names kind of rotating around that. When you look at retail investors, and maybe you've seen the research, whether you've heard from them or just in general how you think about it, do you think when it comes to these baskets of stocks or creating these ETFs, people are basically subbing out some of their high beta names for exposure to them, or actually taking some of their core broad-based index fund exposure and using that money to go ahead and get exposure to these? I'm just kind of curious to get into the mind of the retail investor, how you think about it.
No, absolutely. Honestly, my view was that when we first launched the product, for example, if you had an investor that was really adamant and interested in investing in Tesla, there's no way he's going to replace his full Tesla stock holdings with an income producing ETF on Tesla. We thought, maybe 10% of that portfolio might be sold off so that you can buy some of the income product. But the reality is that people looking for active monthly income, people looking for that monthly cash flow, these kind of people, they don't want to manage individual stock positions on their own, right? So if they're interested in Tesla, they will probably want to buy some version of Tesla that also pays them income, because that's what they're predominantly interested in. So people wanted that sort of one size fits all kind of approach. So what we've seen most, or just in terms of feedback, is that people that have considered investing in higher beta names like the Teslas and Nvidias of the world are just buying the income version of those underlying stocks, just because you're getting a smoother ride, you're getting a similar experience in terms of capturing a lot of the upside, but you're also collecting a pretty high distribution on an annualized basis as well. So we like to think of it as, I don't want to say the best of both worlds, but you are getting some of both worlds, right? So in the case of Tesla, like we saw for the last year, you might even get outperformance. I don't think that's the norm, and in many cases it won't be, but many people are okay with that trade-off. They know that if Coinbase rips 150% for the year, they're probably not going to capture all 150 of that. But if they capture, let's say, somewhere around 2/3 of it, maybe half, and in the meantime they're also collecting dividends, then they're completely happy with that.
One thing which maybe you've even talked to some brokerages about, and something that I see that confuses retail investors a little bit in that area, is the way that they see a chart
Yeah,
versus total return. You know what I'm
yeah,
saying? Where they're looking at a
absolutely.
chart and it's just not reflective of what's actually happening. Do you think that there's going to be kind of like a change in brokerages, or retail investors are educated enough to say, "Hey, I'm looking at this chart and it says it's only up 5%, but
Yeah.
I can look at the year and they distributed 20%."
So what I can say is that if you think that's a problem in the US, just multiply that by 10, and that would be a best case scenario of what you get in Europe. So everybody uses a different platform. Everybody uses like sort of these different data providers where they're seeing those charts. And in
Yeah.
many cases, they're only seeing, as you said, the price return. So even for, let's say, our Max 7 product, what they will just see is something that went up quite a bit and it came down quite a bit, and the cumulative performance is just 0%. So they're like,
Mm.
what am I looking at? But that's why we've actually been actively engaging with different brokers and different service providers to tell them that, hey, you need to get ahead of the ball because people are going to want to see total returns as they
Right.
become more and more comfortable with these products. So there are a few platforms here in Europe that are developing where you can track your dividends, where you can see not only the price return but also the total return. But the website is, I think, one of the core educational pieces that we're going to be able to control directly. So obviously, I keep pushing for more features, but one of the things that we've added is like this simulator. Like, had you invested 10K 3 months ago, 6 months ago, 1 year ago, how much would it be worth now? How much of that would have come from the price gain,
Mm.
and how much would it have come from the total return? So it's going to take some time. There's going to be a lot of headaches, a lot of frustration, but like with anything, it's going to be, the good news is that this is the worst it's ever going to be. So that keeps me optimistic.
Yeah, fair. I really like that simulator idea. That's gonna be built into your website?
I mean, it's currently live. I wouldn't say it's like a real simulator, like maybe in the sense that you're imagining it, but you have these different scenarios where you can pick the time period and it really breaks down the price and total return so you can see what piece is coming from where.
That must be super helpful. I remember at the beginning of this income investing boom, people starting to just build like literal websites just for this type of stuff, and just starting to get a lot of traffic because people are just like, how do I track this? How do I see? So it's helpful that you built
Yeah.
it directly in. And
And,
I agree with you. That is a little bit of comfort to say this is the worst it will ever be, right? Only moving towards better things.
and when you touched on the topic of nav erosion, so when I said that we actively listen to the investor feedback, one of the key catalysts for changing of the strategies was because of that nav erosion.
Mm.
When we first brought these products to market, there wasn't anything like it in the European market. So we had different sort of requirements that we had to meet from, whether it's regulators or market makers, whatever counterparty. But the nav erosion was really bad on some of the products. So
Right.
once we were able to get those counterparties more comfortable, we switched the strategy into something more active and dynamic. So, like I mentioned, with some of the performance figures, not only is the nav erosion to an extent, a lot better now, but in some cases you're actually seeing outperformance. So nav erosion is always going to be, a topic that retail investors are concerned with, and they should be. And yeah, that's one of the main reasons why you really have to do your homework before you get invested in these products, because it's not just about the yield. 100% of a single dollar is just a single dollar. So if your NAV keeps eroding, that nominal amount is just going to go down. Don't be confused by that percentage figure.
Yeah, the education is super, super important. Just looking ahead to the rest of this year, any general thoughts on what you're expecting from the market? Anything you'll be watching super closely? A lot of us, closely follow the US markets. Curious if there's anything as well from the European side that you'd be watching. In the US, we have a new Fed chair that's going to come in, tariffs, other pieces. What else are you watching across the board and on Europe?
I mean, watching the news the last few days, it's almost like a soap opera, right? Whenever you have a longer weekend, I feel like there's tension almost created on purpose for the sake of just having something
Of
entertaining
course.
happen over the weekend. But I think obviously it's very hard to predict anything with certain world leaders. But what I think will play out very similar to what we saw last year is that there's going to be a period of a lot of volatility. And as soon as people have the slightest glimpse of clarity, I think there's going to be a lot of people piling in with a lot more money into, I would say, probably the next phases of this AI play. So, obviously, first it was the Max 7 names, and then we started talking about the infrastructure plays. And then we have some companies that have done over triple digits year to date, and we're barely 3 weeks in. So I think people are just going to look for that, the first glimpse of clarity just before really going all into the markets again this year. And once again, I think big tech is going to make all the headlines, but I don't think we're going to have that broad-based success that we had last year. I don't think there was a single sector that ended the year in red last year. This year, I'm definitely not the person to predict which one's going to do best, but I don't think the outperformance is going to be that broad.
Very fair. Maybe a case right there for some of the income oriented ETFs. Really good conversation for anyone that tuned in. You can find a lot more information. I encourage people to check out your Twitter accounts. The content has been phenomenal coming out from the accounts. A lot of great graphics, insights. There's a few different accounts that people can check out. You can go to the Leverage Shares account. There's also the themes. There's also there's an Income Shares one as well, right? Yep, Income Shares EU. People can check out all three of those. Great information really across the board. Really interesting one on the income shares that I'd point people to go take a look at. You could see the total fund flows, which we've been talking about a little bit, just continuing to really just stack up every month and move in that direction. So pretty incredible stuff. Congrats on the success your firm's seen over the past year. I'm excited to see it continue. Any final comments? Anything else you'd want to share with the audience on this live stream today?
No, thanks a lot for having me on, Gov. Really appreciate it. My only comment to the community would be if you have any feedback, suggestions, comments for us, reach out to us directly on social media. I mean, we're very active. We pay attention to what the community is saying. And of course, if you have any additional questions, you can always email us at info@leverageshares.com. Check out our website, DM me directly, very different avenues.
Beautiful. Thanks so much for coming on today, being a part of the show. Appreciate everybody who watched. I know that this is a super, super hot trend right now. So it's important to educate yourself, especially if you're thinking about investing money into this area. We are going to be back with more content covering this topic consistently over the rest of this year. So continue to tune in. If you do have questions, you can submit them directly to Leverage Shares, like was just said, or you can also just shoot them our way and we will check them out as well. Take care, everybody. Have a great rest.